But let's talk now about what is happening with the price action that we're seeing here in Europe. Alex talked about capitulation. Europe is playing catch up to a certain extent. It is meant to represent value, but nevertheless, relatively, it is still a story that you want to focus on. But in absolute terms, these equity markets are under pressure. Joachim Klement, investment strategist at Liberum, joining us now to give us his take. Joachim, let's just kind of talk about what you're seeing on the screens in front of you. I've got the Euro Stoxx 50 down 3.5%. At one point, it was down 4%. What do you make of this price action?
Well, it certainly looks like a really, really deep Red Sea across the board. The interesting thing is that I think up until basically Friday, the main story was the fears of Fed rate hikes and Bank of England rate hikes here in the UK. This has now been compounded at the worst possible time. In the middle of the fears, we're now getting increasing signs that the situation in Russia is heating up. So we're now getting a compound effect in the middle of a winter when energy prices are already high with these fears. However, I think the big underlying story remains the Fed and the worries about rate hikes in order to fight high energy inflation and high inflation in general across the Western countries.
Joachim, the narrative at the end of last year was let's rotate into value, and value is going to mean Europe. Is that going to hold?
I think it does. You do see a very, very strong rotation into value stocks in Europe, in the UK, and within the US, obviously with the NASDAQ being one of the main victims of this situation. But you also do see the outperformance of the Jurassic Park stocks in the UK and in Europe. So as a result, actually, when you look at it from a duration perspective, so basically looking at the average duration of cash flows in Europe versus the US and in the UK, then the UK and Europe has significantly shorter duration for the equity markets. And that means that as rate fears persist, these markets should continue to outperform, even though they obviously, as we see today, can't avoid losses.
Okay, so this is a relative trade. I'm still going to lose money. I'm just going to lose less of it if I invest in these dinosaur stocks.
It feels reassuring.
Yeah, no, it doesn't sound very reassuring, but that is literally the situation that we're in. The dinosaur stocks are down. And in fact, if you look at it today, energy as a sector in Europe and in the UK is not one of the best performing sectors, which is what you would expect if Ukraine and Russia would be the top driver of stock markets.
Fair enough. We also seen some price action in sort of ECB market pricing. Bets on a 10 basis point hike for the ECB is now pushed back to December from October. What's going to be the read-through to the sell-off, to potentially tighter financial conditions, and then the read-through to central banks' reactions?
I think at the moment, markets are really, really freaking out and kind of going into the extremes in terms of central banks hiking 50 basis points or hiking more than previously expected. In the end, we're already seeing first indications of declining wage growth and declining inflationary pressures, also in the energy space over the last couple of months. Now, that means that we think the central banks will probably not go, and the Fed in particular, not going to hike on Wednesday, but leave it for the March period. And I think what we will see on Wednesday is with the Fed claiming again and showing again that they're on top of things, but they are not in a rush to hike interest rates, that could lead to some relief, particularly in the hard-hit growth stocks.